There is a particular kind of silence that follows an important event when almost no one notices it happened. Edmund Burke once observed that the greatest ease is granted to those who never trouble themselves to look closely at anything. On Friday, something happened in the silver market that rewarded exactly the kind of close-looking Burke had in mind, and punished, gently but certainly, everyone who didn't bother. Silver did not merely rise on Friday, it closed the week at roughly $62 to $63 an ounce, up nearly 6% for the week, its highest level since late June. That, by itself, is a number, the sort of thing that flickers past on a ticker and means little to anyone not already watching. But embedded in that number is a signal, a structural one, of a kind that professional traders and institutions treat with the seriousness Burke reserved for constitutions and settlements, not headlines. And it happened while most people were occupied with weekend plans, entirely unaware that the market had just crossed a threshold 4 decades in the making. Here is why it should matter to you, specifically whether you own an ounce of silver or have never given the metal a second thought. This particular signal is the dividing line between a rally that fades by Wednesday and a move that keeps its nerve. It is the very thing serious money was studying over the weekend as it decided how to position itself for Monday's open. In the space that follows, I intend to walk through exactly what that signal is, why it carries the weight it does, what it may be pointing toward, and, in the interest of intellectual honesty, the very real ways it could still come to nothing. This is not a matter of tips and hunches, it is a matter of understanding, and understanding is a commodity in shorter supply than silver itself. Let us be precise about why this differs from the daily churn you're accustomed to hearing, because the difference is the entire point. Most of what jostles silver's price on any given Tuesday is emotion dressed up as analysis, a frightening headline, an optimistic rumor, traders reacting to one another's reactions. It is loud, it is largely without consequence, and it mostly cancels itself out by Friday. But now and again, beneath all that noise, the actual architecture of the market shifts. The price crosses a line that alters how professionals view the whole terrain. Such structural shifts are rare, which is precisely what makes them worth your attention. Friday, by the evidence, was one of them. And the reason so few caught it is that it did not arrive as a dramatic headline. It arrived, quietly, as a weekly closing price, invisible to anyone who doesn't know what to look for. Before I tell you what the signal is, I'll ask you what I ask everyone watching. Are you currently holding any silver in any form? Say so in the comments below. I do read them. Now to the signal itself, explained plainly, because once you grasp it, you will not look at a silver chart the same way again. For more than 40 years, silver labored under a ceiling. The $50 level was a wall the metal struck in 1980, during the Hunt brothers' notorious attempt to corner the market, and struck again in 2011. And both times, it was rejected and sent tumbling. 2 attempts, roughly 30 years apart, 2 failures. That level took on an almost mythic character among traders. $50, the price at which silver's ambitions went to die. Then, in 2025, something without precedent in living memory occurred. Silver did not simply touch that old ceiling, it broke through it decisively and continued climbing all the way to an all-time high above $121 in January of this year. For the first time in more than 4 decades, the wall came down. But here is the truth about breaching a barrier that old and that storied. The breaking of it is not the test. The test is what happens afterward. Whether the price can retreat, come back down to touch that old ceiling from above, and hold there, transforming what was once the roof into the new floor. That is the moment, and only that moment, which confirms a breakout is genuine, rather than a momentary spike of enthusiasm. And that is precisely the drama that has occupied the last several months. When silver fell from its January peak of roughly $121 back down into the 50s this spring, a great many observers pronounced the breakout a failure. Another false dawn, another rejection, silver returning obediently to its old cage. But watch closely what actually transpired. Silver found its footing, and this past week it came back with force, reclaiming a key technical level in the low 60s and closing the week strongly, up nearly 6% at its best level since late June. Put simply, silver tested the old danger zone from above, held its ground, and bounced. The former ceiling is beginning to resemble a new floor. That is the signal professionals are watching, because if it holds, it confirms that the 40-year breakout is real, and that silver has entered what traders call price discovery. Allow me to explain why those 2 words carry the weight they do, because they are the hinge on which the rest of this analysis turns. When an asset trades beneath a major ceiling for decades, a kind of gravitational pull develops around it. Every advance summons sellers who remember the old highs and push the price back down. The price remains anchored to its past failures. But when an asset finally clears a ceiling that old and holds above it, something changes altogether. There are no sellers waiting up there from the last cycle, because the price has simply never sustained itself at this altitude before. The old anchors are gone. This is what is meant by price discovery, the market genuinely searching for a fair value with none of history's old restraints holding it down. And here is why that carries particular force for silver. The last occasion on which silver entered a genuine breakout of this kind, in 2011, the metal very nearly doubled within months once price discovery took hold. That is simply the nature of silver, a small, tightly held market that, once freed of an old ceiling, does not drift upward so much as lunge. I want to be careful here, because this is precisely where lesser analysis turns to salesmanship. Entering price discovery does not guarantee that silver marches straight upward. It means only that the old resistance no longer restrains it. What silver does with that new freedom depends on forces still to be discussed, but the removal of a 4-decade ceiling remains, on its own terms, a genuinely significant structural event, which is why professionals are watching so closely whether this week's advance holds. There are, moreover, specific price targets that follow from this kind of breakout, and they are not invented for drama. They derive from a technical method called the measured move, based on the size of the multi-decade base that preceded the breakout. Analysts employing this method point toward levels in the low 70s and high 80s as the next technical extensions, should silver remain firmly in price discovery. These are not promises. I will be candid about that throughout. But they are the levels professional chart watchers are genuinely targeting, derived from the structure of the breakout itself, not from anyone's imagination. That is the first signal, the weekly close above the old ceiling. But a second signal is flashing at the same moment, and once the two are considered together, it becomes clear why this particular weekend carries unusual weight. That second signal is where we turn next. The second signal is one that most casual investors have simply never encountered, though professionals watch it with something close to devotion. It is called the gold-silver ratio, and the idea behind it is not complicated. Divide the price of gold by the price of silver, and the resulting figure tells you how many ounces of silver it currently takes to purchase a single ounce of gold. With gold near $4,180 an ounce and silver near $63, that ratio sits at roughly 66, meaning it takes about 66 ounces of silver to buy 1 ounce of gold. That number has a long history, and it tends to swing between extremes the way a pendulum swings between two walls it never quite touches. When the ratio climbs to unusually high levels, meaning silver has grown historically cheap relative to gold, it has, across cycles, been one of the more reliable signals that silver is due to outperform. And the ratio, even after silver's sharp advance from its spring lows, remains in territory analysts flag as a meaningful buy signal for the metal, sitting near a long-term support trend line from which silver's largest catch-up rallies have historically launched. Here is why the two signals reinforce one another. A high ratio tells you silver is cheap relative to gold, that there is room to close the gap, and in every prior precious metals bull market of consequence, the catch-up has unfolded in the same fashion. Gold moves first, silver lags behind, and then silver erupts to close the distance, often moving 2, 3, or 4 times as fast as gold does. We saw this in 2011, when gold rallied strongly and silver very nearly tripled. So when a stretched ratio is telling you silver is cheap, and a technical breakout is telling you the 40-year ceiling has given way, you have two independent signals, one about value, one about structure, pointing in the same direction simultaneously. That convergence is uncommon, and it is exactly what has serious analysts leaning forward this week. Now, two aligned signals are compelling, but signals are only as trustworthy as the real forces standing behind them. A chart pattern with nothing beneath it is merely a drawing. So let us look at what actually underlies both signals, because that is what elevates a technical setup into something worth serious attention. Silver is currently in its 6th consecutive year of a global supply deficit, 6 straight years in which the world has consumed more silver than it has mined. The Silver Institute has estimated this year's shortfall at roughly 67 million ounces, and the demand side of that equation is where the picture becomes genuinely remarkable, because silver possesses something gold does not, a vast and expanding industrial appetite. More than half of all silver demand today is industrial, and that share continues to grow. Solar panels are the largest single driver. Each residential panel consumes roughly 20 grams of silver, and the global build-out of solar capacity continues to accelerate. Add electric vehicles, which require considerably more silver than conventional cars. Add the data center construction driven by artificial intelligence infrastructure, all of which depends on silver and its electronics. Add 5th-generation telecommunications equipment and advanced medical devices. And here's the crucial point. For most of these uses, silver has no adequate substitute. Engineers have experimented with copper and aluminum, and performance has consistently suffered. This is what economists call price-insensitive demand. It does not diminish simply because silver becomes expensive, because no comparable alternative exists. Meanwhile, on the supply side, roughly 70% of the world's silver is extracted as a byproduct of mining for other metals, which means producers cannot simply ramp up silver output because the price rises. Demand that will not slow is meeting supply that structurally cannot grow. That is the underlying fuel. The reason professionals treat a silver breakout with a gravity they would not extend to an ordinary equity chart pattern. The signal says the door has opened. The shortage is what could push silver through it. If what I've laid out so far has been useful to you, if it has helped you see the structure beneath a market most people only glance at, this is precisely the sort of analysis I put together regularly, and I'd ask you to consider subscribing and turning on notifications, because these structural moments do not announce themselves loudly, and I would hate for you to miss the next one simply because you weren't looking. Now, I promised honesty about the risks, and the analysts worth listening to are the ones who deliver the discouraging half as candidly as the encouraging one. So here it is, plainly. First, the signal could still fail. A single strong weekly close is meaningful, but it is not permanent until it is held for a while longer. Silver could reverse next week, slip back beneath the reclaimed level, and the entire new floor thesis would collapse back into just another disappointing rally. One good week is encouraging. It is not confirmation. Anyone who tells you the breakout is now guaranteed is not treating you honestly. Second, the very reason silver rallied this past week can reverse just as quickly. Silver advanced because a weak June jobs report, only 57,000 positions added, well below the roughly 110,000 forecast, with prior months revised down substantially, led markets to trim their expectations of a Federal Reserve rate hike. That expectation can shift on a single data point. There is meaningful economic data still ahead, including further Fed commentary and fresh inflation readings. Should that data run hot, should inflation prove stickier than hoped, the Fed could hold a firmer line and the rate cut optimism that fueled this rally could evaporate along with silver's recent gains. The signal itself is technical in nature, but the immediate fuel behind this week's move was macroeconomic, and macroeconomic conditions can turn abruptly. Third, and I want to be entirely candid here, not every indicator agrees. Several shorter-term technical models are, at this moment, flashing caution after silver's rapid climb from the low 50s into the low 60s. When a market advances that far, that quickly, it often needs to pause and consolidate before advancing further, even within a genuine bull market. It remains entirely possible that silver retreats first, retests that old ceiling once more, and shakes out its more nervous holders before any larger advance takes shape. That would be an ordinary occurrence, not a catastrophe, but it does mean no one should expect a straight line upward. So here is the honest synthesis, the one that separates serious analysis from enthusiasm dressed up as insight. The signals are real, and they are genuinely encouraging. A 40-year ceiling reclaimed, a ratio sitting at historically favorable levels, a genuine physical shortage underneath it all. But none of it is guaranteed. The macroeconomic fuel behind this rally could reverse. Silver could easily retreat before making any larger move. Holding both of those truths at once, the genuinely promising setup and the genuine risk, is what real analysis requires, and what the next section will help you learn to watch for yourself. Let me give you the practical portion now, how to actually follow this signal as it develops, so that you are reading the market rather than reacting to it. The single most important habit is to watch the weekly close, not the daily fluctuations. The daily movements are noise. Silver will jump around from one afternoon to the next, and if you track it minute by minute, you will exhaust yourself and likely make an emotional decision you later regret. What serious market participants watch is where silver settles at the close of each week relative to that reclaimed level in the low 60s. For as long as silver continues closing its weeks above that zone, the breakout thesis remains alive and strengthening. The week it decisively closes back beneath that level, the thesis is in genuine trouble. That single discipline, watching the weekly close instead of the daily chaos, puts you ahead of a great many retail investors immediately. Second, keep an eye on the gold-silver ratio. Should that ratio begin falling, meaning silver gains ground on gold, that would confirm the catch-up trade is genuinely underway, that silver is behaving as the signal suggested it might. A falling ratio is silver outperforming, which is the entire thesis playing out in real time, rather than remaining theoretical. Third, watch physical premiums. Compare what actual silver coins and bars cost from a dealer against the quoted spot price. If those premiums remain firm or rise, even while the paper price dips, that tells you the underlying physical shortage is real and that buyers remain present beneath the surface. Fourth, Watch the coming economic data through the correct lens. When Federal Reserve commentary and inflation figures are released, resist the urge to react to the immediate price spike or dip. Ask instead what the data implies for interest rate policy. A weakening economy paired with cooling inflation is bullish fuel for silver. Inflation that proves stubborn is the headwind to watch. Track these four things: the weekly close, the ratio, the premiums, and the data. And you will understand what is happening to silver considerably better than most people around you, and you will no longer be at the mercy of an alarming headline or an overheated video. There is one further piece of confirmation worth noting, because a technical signal carries considerably more weight when the behavior of serious capital lines up behind it. Exchange-traded products holding physical silver absorbed enormous quantities of metal through the past year, pushing total holdings within striking distance of their all-time record. Hardly the behavior of retail investors nibbling at the margins, but rather large-scale accumulation of real, physical metal being withdrawn from the available market. There has also been a documented migration of physical silver from west to east, with Asian buyers paying premiums over the Western price to secure real metal, alongside a growing preference among institutions for physical delivery rather than cash settlement, and several governments moving to formally treat silver as a strategic reserve asset. Each of these is a form of confirmation. Sophisticated capital positioning in physical silver precisely as the technical and valuation signals suggest it should. None of this guarantees an outcome on any particular timeline, and large institutions are hardly infallible. But when the chart signal, the valuation signal, the physical shortage, and the behavior of well-informed capital all point the same direction, one is no longer looking at coincidence. One is looking at genuine convergence. Which raises a fair and necessary question. If this signal is so compelling, why did it fail twice before? Silver approached this same neighborhood in 2011 and collapsed. What honestly is different this time? Here is what has genuinely changed. In 2011, silver's advance was driven chiefly by investment speculation, people buying the metal as a financial wager. The scale of industrial demand that exists today simply did not exist then. The solar build-out was a fraction of its current size. Electric vehicles were a niche curiosity. The artificial intelligence data center boom did not exist at all. When speculative enthusiasm broke in 2011, there was little real demand underneath to catch the price, and it fell hard. Today, more than half of silver's demand is industrial, expanding, and substantially irreplaceable, which means there is a floor of genuine physical consumption beneath the price that simply was not present 14 years ago. The supply side tells a similar story. Today's deficit stands in its sixth consecutive year, with above-ground inventories meaningfully drawn down, a far more stretched condition than existed in 2011. But candor requires acknowledging the case for caution as well. The fact that silver failed at this general level twice before, in 1980 and 2011, is precisely why some traders remain skeptical, and they are not wrong to be careful. A level that has rejected an advance twice in 4 decades commands a measure of respect. It remains entirely possible that even with stronger fundamentals behind it, silver requires more than one attempt to truly clear and hold this territory, and silver's volatility guarantees the path will be turbulent regardless of the ultimate direction. So the honest conclusion stands as follows. The fundamentals beneath silver today are genuinely stronger than they were in 2011. The industrial demand and the supply deficit are real, and they are new, which is a legitimate reason to believe this attempt rests on firmer ground than the last one did. But history also counsels respect for this level, an expectation of volatility, and no assumption that the path forward will be a straight line. To draw the whole picture together, this past week, silver closed strongly, reclaiming a key level and confirming, at least for the moment, that it is holding above the ceiling that rejected it for more than 40 years. That is the first signal, pointing towards silver being in genuine price discovery, freed from 4 decades of overhead resistance with measured move targets in the low 70s and high 80s, drawing the attention of professional chart analysts. At the same moment, the gold-silver ratio sits near levels that have historically marked a powerful buy signal for the metal, close to the trend line from which silver's largest catch-up moves have tended to launch. 2 independent signals, one structural and one about value, pointing the same direction at the same time. And underneath both sits the real fuel, a genuine 6th consecutive year of supply deficit and industrial demand from solar, electric vehicles, and artificial intelligence that cannot easily be substituted and shows no sign of slowing, set against supply that structurally cannot expand to meet it. But the risks are just as real as the opportunity. The signal requires more time to confirm. The macroeconomic fuel behind this week's rally could reverse if inflation proves stubborn and the Federal Reserve holds firm. And after such a rapid advance, silver could easily pause and retest before any larger move takes shape. The setup is genuinely compelling, and the risks are genuinely present. Anyone who offers you only one half of that truth is either misinforming you or misinforming themselves. 99 people out of 100 who hold silver will walk into Monday's open watching only the price, feeling relief when it rises, panic when it falls, entirely at the mercy of the next headline or the next hyped-up video because they have never troubled themselves to understand the structure beneath it. You are no longer among that number. You understand what actually happened this past week. You understand what a weekly close above a 40-year ceiling signifies. You understand what the gold-silver ratio is indicating, what is fueling it beneath the surface, and, just as importantly, precisely what could still go wrong. That understanding, and not any prediction, is the most valuable thing an investor can carry into an uncertain week. So here is my genuine question for you, and I would like your honest answer. Do you believe silver holds this level and confirms the breakout, or do you expect a retreat and a retest first? Tell me which and tell me why in the comments below. The conversation beneath these videos is often sharper than anything found on mainstream financial television, and I read every one of them. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind. Prices and figures cited here reflect verified public data as of early July 2026. Silver near $62 to $63 per ounce, gold near $4,180 per ounce, and an all-time silver high of $121.58 to $121.67, set on January 29, 2026. And you should confirm current levels and consult a licensed financial professional before making any decision involving your own money.